behavioral biases and 15 most common mistakes that investors makes in stock market. Now I decided to do this 2 hour course primarily because there are so much of material out there honestly about behavioral biases, behavioral finance, behavioral economics, different courses from Columbia, Chicago Booth, and then there is books that has been written by Daniel Kahneman, the Nobel Prize winner, who wrote Thinking Fast and Thinking Slow. Then there are books, Charlie Munger, who the most famous legendary investor, who has dedicated his life studying human misjudgments, human behavioral biases. But having said that, I did not find a particular book or course that maps all those biases out there against the most common investing mistakes that actually happens in the markets. So I decided to do this course where I bring in 14 or 15 most common investing mistakes that happens in the stock markets, and what are the respective behavioral biases that causes it, right? I've taken information from whatever I've studied, from Charlie Munger's misjudgment paper and talks, and Parag's book on behavioral biases, then the course I took, and multiple courses that are out there, the book Influence. Many of those biases I've stitched together, and whatever I have experienced in the markets, I mapped it to those mistakes, what behavioral biases causes those mistakes, so that you can benefit from not going again from scratch and doing those mistakes again. These mistakes are bound to happen even today and tomorrow, even after you do this course. I'm not saying this is foolproof, but there is a process that we can lay out to avoid the behavioral biases, because whenever you set up a process, it eliminates most of the biases out there. When it is methodical, it eliminates the biases. Whenever there's a human involvement in decision making and calculating probabilities, there is always biases that causes misjudgment, and the idea is to avoid those tendencies and the biases so that we reduce or eliminate those mistakes if possible. So let's get into the course, right? So what is a prerequisite to this course? It's a real game changer, as I said. Human behavior, be the tortoise. There is a reason why I'm calling be the tortoise in the game of investing, because that's what wins the race. Now this is a good module to revisit. Coming here, what is behavioral finance? It's a study of the effects of psychology on investors and their behavior in financial markets. So behavioral finance, it's called behavioral finance because it applies to the financial markets and applying all the psychological stuff on the investor's behavior. If we simplify, all the great wealth is created or destroyed by a single factor in markets, that is human decision. So there are millions and zillions of discussions around investing and books around investing, and there are debates what creates wealth, etc. But honestly, it all drills down to just one word that you can attribute to. It's called human decision, because all the things are driven by the decision we make, whether to buy, whether to sell, whether to buy more, whether to sell half, whatever reason, right? Or to hold. All these are decisions that we are taking, and the decisions that we take every day, not only in investing, every aspects of life, are driven by our own biases that we have developed, inculcated from our childhood without we realizing it, voluntarily, involuntarily. Now, any action we take, are driven by, in financial market especially, is driven by a lot more pronounced way by by behavioral biases, right? Because it's a lot driven by emotions. The decisions are driven by emotions and cognitive biases, right? So they are called cognitive biases or behavioral biases. Now, what are the different type of biases out there? I have put together all of that we will cover in this course. Human decisions in financial markets are influenced by sunk cost fallacy, prospect theory, risk aversion, myopic loss aversion, confirmation bias, regret theory, analysis paralysis, herd mentality, availability bias, notional loss, anchoring bias, overconfidence bias, mental accounting, hindsight bias, halo effect, and the list goes on. I've just covered a comprehensive list that we are going to cover. There are so many that is getting discovered every day, but I wanted to create the biggest ones right out there. Now, next, what are Charlie Munger's tendencies? So Charlie Munger had dedicated his life towards learning about human fallacies and human misbehaviors and human dysfunctions caused by behavioral biases. And he couldn't find any courses out there. He took a lot of courses basically, and he started collecting, the human fallacies and biases, and created a book. I mean, created a big collection of models, and he put that together in Poor Charlie's Almanac book. We all would have read this book. I had referred this. If not, it's a good idea to at least visit the last chapter. Now, well, in talk 11, that chapter where it's called the psychology of human misjudgment, it's a must read chapter. There are 25 human psychological cognitive biases that Charlie Munger talks about, and there are a lot of them that will overlap with the ones I put in the previous slide, because the ones I put in the previous slide are the most common ones out there that is taught, etc. So I thought I'll pull those, and many of them are overlapping in this. So it is not that it's mutually exclusive, right? So there are a lot of overlaps, but it's a good idea to go through this as well, if at all you get time. This is the only reference I could do in this aspect from tendencies and human behavioral biases is concerned. Now I'm going to explain why learn behavioral bias in investing. There are thousands of books, materials, and videos out there about investing and businesses. In this digital age, it's very easy to do to get information, to do the analysis. Look, in 80s, 90s, used to be a lot of arbitrage opportunities that existed because of information arbitrage, because information was not available to everyone at the same speed, because Warren Buffett used to get Wall Street Journal the previous evening or something like that, and many of the leading investors had such kind of internal connects and information advantages, due to which they were all successful in those days. But not that's one of the reasons, I would say, to their success, right? Because information arbitrage existed. But today's digital world, even before Warren Buffett reads something, we can get that information from Twitter or social media and Facebook, CNBC and all that, right? So there are even people talking about stocks and companies in social media. So it's more, the information is unabated, and it's available, like it's a deluge of information, I would put it, right? It's a flow of information. So what advantage does the local retail investors like us have, common people like have, when all the information is out there? Now, the only difference that makes us a better investors is the advantage that we have as retail investors is, or one of the most important advantage is, that we can get an edge over the behavior aspect, which we can control, by the by. So the temperament we can develop, patience we can develop, the right mindset we can develop. We can go through the behavioral biases courses like these and take advantage of the anomalies that exist in the markets. Today's world, it's all driven by algorithms, right? So all the decisions are made by machines. So we have an advantage, we have an edge of having that intelligence and intel towards different biases that exist. So if everyone is in having all the information, why is that 1% of investors only making money in the markets? Because those 1% of the people, as I said in the beginning, have the right mindset, right wiring, right temperament. We can develop that, right? So temperament is the key to the game of investing, not IQ. It's not intelligence. Unfortunately, most people confuse both, right? I mean, people think that the intelligence, we have been wired to think like intelligence carry us, and the hard work and learning all carry us towards a greater success. But in the world of investing, the game of investing, it's temperament. Investing is not a game where the guy with 160 IQ beats the guy with 130 IQ. Once you have an ordinary intelligence, what you need is the right temperament to control the urges that get other people into trouble in the world of investing. That's quote unquote from Warren Buffett directly. What he had was the right temperament. Now, that's the end of introduction slide. And I'm going to move into the module 2, which is nothing but the first 5 biases that we will see now. So module 2 is 15 biggest mistakes made by investors and behavioral biases associated. First 5 biases and mistakes, right? Now, the first one is stocks are not few trading tickers. There are really underlying businesses. Although many of us know this, right? Today's world, we all are aware of market capitalization. At least when I started investing in 2010, 11 timeframes, at least most people didn't know about market capitalization, how to value companies, But today, everyone knows about how to value companies. Everyone talks about, at least in the corporate world, people talk about, Apple being a $3 trillion, $2 trillion, Microsoft being $1 trillion, whatever, right? So at least people are talking about valuation of the company in that aspect. But when I started, even 4 years back, people used to talk about stock prices being high because the ticker prices are low. If the stock is trading for $30, that stock is considered as low priced, cheaper. And if the stock is trading at 100 or say $1,000 or $300,000 like Berkshire, that stock was considered extremely pricey, right? So that's not the way to look at it, right? It's a market capitalization valuation. Now, today's world, many people know that there are stocks behind the tickers. But what happens really is, now for example, this is a perfect time to take this course. Actually, there is a market carnage out there. Stocks have fallen 70-80% on an average globally in many countries. So it's a perfect time. I don't think I can get a better time than May 2022 to take this course, right? So what happens is, there is a confusion between investing and speculation. Although people know that there is a business behind the ticker, the speculative mindset takes charge of the investing mindset, the long term mindset, most often, especially on the extreme conditions, right? Most common mistake, especially made by new investors, are the speculation rather than investing. They think that they perceive low ticker price, as I said, as lower stock price or cheaper stock price than stock price ticker prices, which are 4 digit, 5 digit. They then remember stock ticker price very well, but nobody knows the valuation. Everyone can say by heart, if you ask whoever are investing in market, they know the stock ticker price. If you say Upstart, for example, the stock fashion today, everyone would know that it's trading around, I don't know, I mean, $100, whatever, right? I don't track ticker price. Most people will know the ticker price, but they will not know how much is the Upstart valuation in terms of market capitalization, which I know maybe it's around $6-7 billion right now, right? So that's the way people look at the stock market price, right? So the solution to this is overcoming this is think that there's a business behind the stock ticker price and learn to analyze and value the business. So if you analyze a business with the valuation in place, you don't have to really worry about what happens when the market carnage happens, what happens when the bull market goes up, should I sell, buy, etc., right? So you're thinking like a business owner. When you think like a business owner, the stock price corrects 30%, I'll be happy, I can buy more shares of my own company that I own. That's the mindset we need to develop, right? So why this happens, it's because, as I always told, there are only two emotions in the stock markets, just two emotions: fear and greed. Everything else is in between, is just oscillating between these two conditions, right? It's fear that keeps accumulating, or it's a greed that depreciating. That's always the case in terms of bull markets and bear markets. So those two emotions take charge of our mindset, and then we tend to think speculatively. Even today, I also go through this. It's not that I'm off all this. Today, when I see my stocks holdings going down 50%, for a minute, for a few minutes, I will think, oh man, what is going on here, right? The stock price is down 50%. Then I also start getting speculative, right? I then think, oh, will this price go up? Will the stock price, what are the micro conditions? So our mind automatically gets driven into those directions. So we need to take control of that and think like this, right? Look, okay, the stock is corrected 50%. What is the business behind this? For example, Upstart, they are into the lending business. They are disrupting the scoring mechanism globally, which is a multi-trillion dollar industry, and they are getting into the mortgage. They are having optionalities. Will 5 years down the line Upstart be a $50 billion market capitalization? Yes, maybe. Or maybe 25 billion? Yes, maybe. So should I be worried about, or should I start accumulating at $5 billion? So that's a mindset we need to attune to. That'll help a lot. Now, why does this happen? Why does this mindset gets driven towards speculative, even though we are aware there's a business behind it as investors? Is because a famous bias called framing bias. There's a very famous bias. Now, here's an example, right? McDonald's, put an ad. I think this was in early 90s. They put an ad like this, what you see on the screen. It's called New McLean Deluxe. Okay, and you see that burger out there. It says 91% fat free. Pretty alluring, right? 91% fat free. As against, think of it, if they put instead of that 10% fat involved, human minds will think, will get panicked. You mean 10% fat in that burger? But people think 91% fat free or 98% fat free makes us think that, wow, this is alluring, right? So that's the framing mindset. It's like it occurs when people take decision based on how someone presents the information to us, as opposed to focusing on the facts themselves. So how the presentation of the information comes to our mind, comes to our eyes, we fall for its optical illusion, right? And this is exactly what's happening when the market crashes happen. Like, the media out there is shouting, there is so much of noise, there is so much of messages that come in Twitter, there is all around panic, people are throwing up information like that, and media can frame it beautifully. I'll put it in the next slide, right? Let's see this. Look at this. Why do people sell in panic when market crashes? Look at some of the snapshots there. I'm not particularly taking any particular media here. Every media goes through. That's a selling proposition. We can't blame them. They are winning on their selling proposition. But that's a framing bias that is caused in our mindset. Look at those images. With people holding their head. People shouting. Look at those images, right? I mean, that, and look at the headlines: market crash shakes the world, the global recession, unemployment, end of the world, the war. Who doesn't get scared out of all of this? So the way the media presence, the way the social media presence, the way social media people talk. Now, to add on to that, today's world, we have so much of social media, right? Twitter and messages and WhatsApp groups and Telegram channels, everything that's good enough to bombard with so much of information, so much of fear into our mind, and greed at the same time. On the other extreme, we get carried away. The speculative mind just takes away. I have done the mistake. Every one of you would have done this mistake. We would have got carried away in bull markets. We wouldn't know whether to sell. Although we know it's the right point of time to sell, we just stay to the last music. Same with bear markets. We do sell of speculative mindset. So how much ever we can learn these biases, there is only so much we can act. But it comes through practice. It comes through experience. It comes through diligent and deliberate exercise of our minds to take control, to take charge. That's a fight. How to handle this framing bias? An investor need to be successful in the market is having a rational mind. One needs to think rationally about the business prospect of the companies, analyze the reasons. As I say, explain Upstart's example, right? When the stock corrections happen, we need to arrive at an independent decision. Now, I arrived at an independent decision. I shared with all the academy members, like, look, Upstart is going through this turbulent phase. They have loans on the book, which was unprecedented, unanticipated, but it happened. But look at the optionality aspect of it. They could get into future SMB selling. It could be, you never know which part of the business will click. As I always say, right, that is also covered in the future. So we need to arrive at our independent decision. We need to have a rational mindset. And it can be done only through system 2 level thinking. That is defined by famous behavioral economists like Daniel Kahneman. One of my favorite is Daniel Kahneman. He has written many books. There is Fast and Slow Thinking. I think the book Fast Thinking and Slow Thinking, I think it's something like that. I had referred that in the previous Game of Investing. I had read that book, very dry book, but a lot of information to gather. And Daniel Kahneman and Tversky, as I introduced them in the Game of Investing course, the chapter 7, they have published a lot of papers as well, which will be very helpful for us to learn the different biases out there. Now, the core takeaway is system 1 and system 2 thinking. System 1 is our impulsive mind. It's our natural instinctive mind that works, the human survival mind that came from our survival era. It takes less effort to arrive at decisions. We take quick and automatic decisions. When you think about it, when you drive a car, many of the things are taken involuntarily. It's quick automatic decisions. Those are called heuristics, shortcuts in taking decisions. Those heuristics are helpful because you cannot have a system to mind and drive the car. Initial days, yes, maybe, but eventually it takes over, right? System 1 takes over. Similarly, many of the mails that we write in offices, tasks we do in office are all driven by system 1 thinking. But then sometimes, especially in markets, especially in extreme conditions, we need to bring the system 2 level of thinking. What is system 2? For example, if I ask you 3 to the power 3 times 2 to the power 4, you need to pause. It doesn't come with a natural heuristic. You need to take that pause and calculate, apply our brains, apply our mind, and take the effort of a mental activity, then arrive at the answer. That slow level of thinking, system is system 2 level of thinking. It involves deep reasoning, excuse me, analytical thinking, and arriving at well thought decisions, right? So we need to bring that system level 2 thinking. That's not only for framing bias, but across all the behavioral biases can be resolved if we're really being rational. Second mistake in the market, not selling duds, even if it's a mistake, and selling winners too early. Cutting the flowers and watering the weeds. This is a very typical scenario in markets. Most investors when a stock purchase the we when a stock we purchase goes down by 30%, 50%, 80% from our purchase price, cost price, we'll tend to hold the stock until we recover that loss. Because it's true, even if you understand that if you make a mistake in purchasing that stock due to genuine mistake, even then, genuine mistake could be like overpaying higher price if you had overpaid for the stock. If you've done the wrong analysis, if the management is wrong in the way they are navigating the future of the business, in spite of all those mistakes, we realize we don't sell them because our inner mind doesn't allow us to cut the losses, right? So similar thing happens when a stock doubles or triples. On the other side, it goes up a lot. 99% of the investors sell and book profits. Even if a stock doubles or if the stock goes 50%, many smart people I know, many smart people ask me a question like, should I sell it? Is it time to ring the bell and book the profits? And I get stunned by those kind of questions because, and many people ask me, why didn't you sell when it doubled? Now that it has fallen 50%, why didn't you could have sold it when it had doubled or tripled, right? Well, profit taking, I'm not against it, but it should be driven by rational minds. If you think that the stock doubled or tripled and the valuation is gone up too crazy too fast, you can ring the register. I mean, you can book partial profits, nothing wrong in that, right? But the idea is, look at it this way. The real wealth is created when people get 100 baggers, 50 baggers, 200 times, 1,000 times of the stock returns of the portfolio. And there are very rare gems out there, like, countables. Out of 5,000 shares traded globally, or 8,000 shares globally, or 15,000, it could be like there'll be like 15, 20 stocks that goes up 100 times in the lifetime. And when you hold one of those, when you get one or few of those stocks, it's worth holding them for life, because those are the stocks that makes life, not income. Those are the stocks that make life, right? So both ends, selling after it doubles or not cutting losses after it falls down 60%, both are big mistakes. What biases cause this? There are two biases associated with this. One is sunk cost fallacy. You have heard this term. Second is prospect theory. Very famous behavioral bias is risk aversion and loss aversion. There are two principles associated with prospect theory. Now, let's get into this. Sunk cost fallacy. The picture is a little funny because I just try to put it some pictorially. What is sunk cost fallacy? It is a greater tendency of people to continue an endeavor once an investment in money, effort, or time has been made. You have put in effort, put in time, you have put in money. People tend to continue that endeavor instead of cutting losses in a flawed investment decision, even if the rational decision was to ideally accept the mistake, cut the losses, move on, right? But in contrast, people try to hold on to that good money after the bad investment to average the cost induced by the sunk cost fallacy. That's sunk cost fallacy. You already sunk, you want to recover out of that and come back up, right? That's a fallacy. And you can come over by system 2 level thinking, as I said. You can apply something called as bygones principle. Applying bygones principle. By what is that? It's a theory that emphasizes the importance of ignoring past cost and only taking into account the future cost and benefits when making decisions, right? Especially in today's world, bygones principle is pretty applicable because there is no transaction cost involved, right? You can buy and sell it in any number of times, unless otherwise you're doing international transactions, right? So you can always cut your loss and move into another great winning stock that you already hold, or maybe a new stock, and try to recover the loss from the new investment. What difference does it make when it recovers from a new investment or from the same investment that you made? But the human minds won't let you do that. To cut losses 50%, 60% when you make a mistake, accepting that mistake and cutting the losses is close to impossible for human minds, and then keep moving on to the new stock, right? It's very difficult to think that way. Prospect theory, risk aversion and loss aversion. Now look at that graph, right? So you have the graph reference point in the center, right? And on the right axis, it's an outcome on the x-axis, and it's a value on the y-axis. So what happens? $100 loss feels more painful. Okay. You look at the left third quadrant, right? The losses. It's a significant drop. So the drop is nothing but in the value. We feel really bad, right? That's why we are feeling extremely bad. The curve just deteriorates. Whereas a gain, even if it is $100, it's a slow process. We tend to be okay with that kind of a feeling. But the loss feeling is much, 2 to 3 times, based on the theory and research by analysts and economists. The pain of a loss is 2 to 3 times more than the pleasure of a similar amount of gain. You win $100 gain, you have $100 loss. The pain is 2 to 3 times on the loss than the gain. Now, investors always hate to suffer losses and are all loss averse in nature, right? This is why investors hold on to the losing investments and sell their winning investments faster. Why do they sell winning investments? Because they don't want to lose the profit they gained. That doubler you get, or 50% upside you get, you don't want to lose that. People want to grab that loss profit, so that if it falls after 51, after it doubles, what if it falls 50%, 40%, you will lose that money, right? So you don't want to lose that gain. So that is loss aversion. And on the reverse side, when the loss happens, you don't want to recover. You want to recover through the same investment. You don't want to cut losses, because mind feels that you're cutting losses. That's called myopic loss aversion. Myopic is illusionary loss aversion, right? Because it is it is a decision making due to uncertainty. So that is a prospect theory very quickly, right? But there is a lot in this. You can do deep research if you're interested. Now, here are real-time examples. As I said, this course contains real-time examples, right, with real practical stock scenarios. So it will help you correlate. How will we get a 50 or 100 bagger after if we sell after stock doubles, right? Let's take the example. Okay, I have not put the name here, but it's Netflix, right? I think it's Netflix. But look at this graph, right? In 2014, prospect theory applies. Most people sell when the stock doubles or goes up 50%, even to retain the small profits made, right? If they had sold in 2014, because between 2011 or 2012 and 2014, the stock almost doubled. So most people will be tempted to get the profits, right, after it doubled. That's prospect theory. But if we had sold that at levels of, say, $30, it went up all the way to $180, right? Now, the myopic loss aversion applies even today, right? Because today the Netflix stock has corrected almost 60% from the peak of May 20. I mean, from the peak of, I think, Jan 2021, probably. Most people sell the stock when it corrects 50 to 60%, because they think that it can further go down. What if the profit they made until now, somebody's holding? I'm talking about, suppose somebody's holding from 2012 onwards. They did a good job holding until now, right? But they might sell now, because they will think, okay, I've got from the 2014 levels, it has almost gone up 3 times. At least I've got that. Let me book the profit before it falls further. They will sell it. Now, what typically will happen? The stock will go from. So ideal way to behave there is you can add more at the current levels of 200, right, or 180, whatever levels it is, but 180 levels, right? But what investors would do, they will sell it to book. They will look, I got 4-bagger, I'm going to sell. Netflix is done, the story is done. But what happens in next 5 years? Probably stock will go from 200 to 1000. It's a 5-bagger if you invest more now, right? So, or it could go to 600. Fine, it's fair enough. It's another 3-bagger from now, right? You're not losing much. But the behavior is always opposite. I mean, this is what I'm trying to explain, right? So that's prospect theory in action, right? And another question I had is, how will we get a 50 bag? If suppose somebody bought a stock at, say, $20 in 2010, it is a 50 bagger, right? Or 100 bagger from last decade. So nobody would have got if you sold it at 2 times, 3 times. You will never get a 100 bagger, right? Think through that. How to overcome the prospect theory bias and loss aversion bias, and how to correct these mistakes. Read 2 mandatory books if you want to be successful investor. Those are the references in this course. 100 to 1 in the Stock Market by Thomas Phelps. I've given already this reference in the previous Game of Investing course by Chris Mayer. There is a new book, 100 Baggers. That's another book. Those 2 books are must read. There is an article written by Chris Caron on Acre Capital. Chuck Acre, I think he found the Acre Capital. He also has written many papers, but this article is titled "The Art of Not Selling." It's a must-read article. So these 2-3 books and the article will help you give a good directional view on prospect theory and how to handle that bias. Now, in the book 100 Baggers, Chris has vindicated his point with an example of Monster Beverage Company, which has given the highest and fastest wealth for investors the last 2 decades in the market. Monster Beverage was a 100 bagger from June 2004 to 2015. I think it's still a 100 bagger. It took 11 years to multiply 100 times at a CAGR of 50%. So a quick, knack to think about. If you have a CAGR of 50% for a decade, you get a 100 bagger, right? Easily said than done. Very few stocks are like that. Now, Monster Beverage stock fell more than 25%, 10 times in those 11 years. The fall of more than 25%. It could have even fallen 50% probably in March 2020, maybe going through now. Stock fell more than 40% three times in those 11 years, 40%, more than three times in those 11 years. Now, many people ask me recently, like, Upstart has gone down 70, 80 percentage. Can a stock really come back 80 percentage up? So if Monster Beverage had fallen 40% three times in 11 years time, and it still made a 100 bagger, possibility is there. I mean, the business continues to deliver. There's nothing stopping that, right? So Amazon had fallen, I think, 90% in 2000. And from there, it's a 1,000 bagger, probably 100 bagger, I don't know. So always possible. Markets is a short-sighted animal, and price movements can be influenced by emotions in the near term. So we need to take charge of that. Stocks can get corrected 30, 40, 50 percentage multiple times. It's not nothing new. It is 60, 70 percentage might be a little extreme, like what's happening now, because the excesses were also so much in 2021 year. So much liquidity was gushed in. So much excesses was there, the correction will be deeper. But 50% is natural, normal. And stocks can that multiply 50, 100 times, start usually as a small mid-sized company, and such stocks will be very volatile when the market falls. So if you want a multi-bagger, the pain of creating huge wealth is going through these turbulent times, right? There can be long holding periods of zero returns, even up to 5+ years. Netflix, Tesla did not return anything for 7-8 years, and then gave a 100 bagger. So this is this is a normalcy, because the stock market returns are sporadic in nature. They are never linear. They're non-linear, and all the returns can come in, as I said, very non-linear way, and for most of the multi-baggers. So hope that helps, right? Now, how to overcome this bias? There's continuity. There are two common mistakes that every legendary investors, if asked, would point to when they are asked about core learnings or regrets in investing. You ask any legendary investors interview was, they will say two main mistakes. It's selling their investments too early, the mistake of commission, right? Selling too early. Second mistake, not buying enough of the winning investments. Those are two common mistakes. How to avoid selling winners early? Listen to Charlie Munger. He said the first rule of compounding is to never interrupt it unnecessarily. Sorry, right? So unnecessarily do not interrupt the compounding machine. Just let it go, let it run. If you're willing to react with equanimity to a market price decline of 50%, 2 or 3 times a century, you are not fit to be a common shareholder, and you deserve the mediocre result you're going to get compared to the people who do have that temperament, who can be more philosophical about these market fluctuations. So coming directly from Charlie Munger, quote unquote, if we are not willing to take that gyrations or market corrections of 50% or more with equanimity, with indifferent attitude, we don't deserve to be in the markets, period. So investing is not in equities, is not for us. Situations where our analysis and beliefs in a story can be wrong, and we continue to hold the wrong stock, right? It dampens the investment returns of our core portfolio. Happens when we do a lot of research and discover stock ideas. We tend to cement our conviction stronger. Our belief and confidence in the company tends to become more and more stronger as we analyze the company and its prospects deeper. The deeper we analyze a stock, the more we get emotionally attached to the stock. This is caused by a famous behavioral bias called confirmation bias. Now, holding a stock with a high valuation, and will tend to look for evidence to justify the valuation, confirming based on company's huge future growth prospects. That is an example, right? I mean, we'll disregard any data that will confront the high valuation of the company. We all go through this. Even I have done this. I have held on to investments that are emotionally attached. I mean, mainly holding wrong investment idea, for a couple of years, in spite of knowing that, in spite of knowing, rather not knowing, in spite of having the data, right, against that company. I had a company called BPL Limited in India. It was one of the failures for me out of 30, 40 investments I made till now. And, that mistake was not rectified immediately because I kept holding on for a year. I had to sell at a big loss. And, once I realized I could have done a little more research there, I could have gone through and believed in the data that was available to me. But my mind was kind of, because I did a lot of research, a lot of vested interest, the confirmation bias peeped in, and I started disregarding all other information and started believing what my core thesis was. But having an open mind is very important to come over the confirmation bias, right? Now, it is like a common bias that we all have in terms of when we make friends, when we make colleagues, when we become close to people, when we work in offices, when we look at our peers, when we look at evaluating appraisals for our team members. All these things are performance appraisals, right? So all these things are influenced a lot by confirmation bias, because we tend to have a bias that creeps in like, yeah, this person is good. uh, he or she could have been good, right? Even in, for example, in a performance appraisal, and for say a couple of years the person was good, and then the person stopped working really and had shown that they're working, etc. And whatever, say, I'm just putting an example, and we continue tend to believe that they are excellent, and we kind of disconfirm any kind of evidences that come against it. We tend to be more partial, we tend to be more biased towards that excellent performer for whatever reason, in the first impression, etc. So we tend to have our belief. In the diagram you can see our brain tends to have a belief. It's preconceived, it's predetermined, premeditated, and then we tend to ignore even from the facts and evidences. We tend to choose what we want to believe, right? What we believe in, we choose those evidences and disregard the remaining. So that is kind of a confirmation bias. So it happens a lot in investing also, when we are, especially for big investors who come in public and talk about their big investments, like Tesla, or Titan, or whatever, right? Alibaba. They tend to have the confirmation bias in a lot, because they are vested interest. They tend to not like when the interviewers ask questions about against their beliefs, right? So these kind of things are very common in investing world, especially. But this can be easily overcome, when we think rational mind. So how to overcome this? Having an open rational mind. As Charlie Munger said, rapid destruction of your ideas when the time is right is one of the most valuable qualities you can acquire. You must force yourself to consider the arguments on the other side. Always have a rational mind, have an open mind to listen to the other side of the argument. It's always a good idea, if you're an investor, to have a friend who can do a devil's advocacy, right? The friend can ask some questions against your belief, and you receive it with an open mind. You tend to accept that, okay, the friend is trying to help you. Answer those questions diligently, not try to prove anything, not try to prove and make a fool out of yourself, but being diligent, having open mind, listening to the other observations, other side of arguments is a very good idea. And rapid destruction of our own ideas is the beginning of success for our future. The minute we start distracting our own ideas, our own previously held beliefs, and our own strengths, and thinking that there's no longer enough, and starting a new path is always a great idea to to have a trajectory of growth ahead. That's a growth mindset. Now, the fourth biggest mistake is fear of stock markets and not investing in equities at all. This is a very common mistake. It used to be a very common mistake hitherto until 2020, 2019. But the last 2, 3 years, I'm seeing a lot of retail participation from the market in the markets. But again, it is bound to go back to that stage, where people are now, it's already happening as we're talking, right? I mean, the flush out of the retail investors, common people who are invested in equities, unfortunate, but that happens because the market tends to, most retail participants tend to get attracted towards the market when the market goes up, and they tend to come in herds to start investing at the peak, lose out 70-80%. We are just seeing that, right? And look, I'm also invested in the market. My portfolio is down 50-60%, but I can add more now, and I know average out will work out. And also, like, I had invested much longer. I'm investing since a long time, so the cost price tends to be much lower than people who come, especially in the peak of the bull market. They want to invest in the peak, unfortunately, or even if we say they want to start somewhere, right? So, and then what happens? The retail crowd gets flushed out when such kind of scenario happen. Now, example, when stocks correct 70-80%, people panic, sell out whatever they have, and then they don't come back to the markets for many years again until the cycle changes, right? This is a typical scenario. So most people fear of losing money if they invest in stock markets, right? That's called regret theory. Now, the fear of regret, which arises in people anticipating regret if they make the wrong choice. Now, what happens? People are not yet in the market. They will think, look, this is what happens in the stock market. You don't want to make that mistake. I want to avoid that regret in the future. I will avoid that regret at any point of time. So I will not even invest in equities at all, rather invest in gold or real estate. So it's a potential future mistake you're trying to avoid, or future regret you're trying to avoid. That is a regret avoidance theory. And this is happening a lot in investing world. I pictorially represented that, how to avoid that. People tend to not even come to equity market because of that regret avoidance. And some people tend to move into index funds, although they are capable of investing in equities or stocks directly. They tend to choose index funds, thinking that the mistakes in order to avoid the regret. There's nothing wrong in that, but I'm saying, right, that is a bad experience that teaches people, and losing capital makes them avoid regret in future. So how to overcome this bias and correcting investing mistake. This is a very interesting mistake, right? I would say risk taking capability is one of the most important habit, or most important attribute, or most important mindset that most successful investors had. Whether you take George Soros, any in great legendary Benjamin Franklin, sorry, Benjamin Graham, and Warren Buffett. When you look at any of the old John Templeton, old investors, old time investors, everyone, or Rakesh Jhunjhunwala, you take R.K. Damani, you take even the entrepreneurs like Alibaba, like Jack Ma or Ma Huateng, whoever you take, most of the people are out there in the Forbes list because they are risk taking in nature. They are inherently risk taking nature, or otherwise they still take risk with the calculated measures, right? There is, it's not that we are saying you should take risk without outweighing it against the rewards and the losses and the mistakes and everything. You should evaluate risks and alternate options like investing in index funds, etc. So evaluating the risk is very important, and avoiding that opportunity loss is very important, right? So the opportunity cost of not investing in equities over 2 to 3 decades, that value can be really scary. It can be millions and billions. People don't understand this. If you miss out the opportunity of investing in equities, the power of equities, leverage of equities, and compounding, it's huge. So avoiding equities is not a good idea. Instead, you look at alternate options, risk options like index funds, lesser riskier, right? But not going into deposits, bank deposits, and real estate and gold. It's nothing wrong. Real estate is good, but you need to have an asset type, some percentage of assets in equities, right? So risk taking capabilities are important before you venture into any entrepreneurship, including investing, right? So nothing ventured, nothing gained. Benjamin Franklin said this centuries back, right? So it's very important to venture into something, take that leap of faith. With a leap of faith, that gains a lot. And Wayne Gretzky, the famous Hall of Famer ice hockey player, who said, like, he summarized, you miss 100% of the shots you don't take. So if you're capable of investing in stocks directly, you should do that instead of just sacrificing that 10-15% alpha returns. You should invest in equities directly, so it goes a long way. So the mistake is just understand that, the power of equities. Do not run away. Regret theory is something you could avoid. Number 5, tracking portfolio values daily and frequent activity, short-term thinking. Now, if you take away all the 15 mistakes I put in, the most common mistake is this: tracking portfolio of stocks daily. I know people who had not invested at all in their lifetime. Once they started and they were not bothered about their financial status, they were not bothered about net worth, nothing, until, because they might be having money in gold or real estate or whatever, and they cannot understand the value, or they cannot get the value or valuation of the gold or real estate every day, right? If you hold 3 houses, how will you know what is it worth? You know it once. You don't go and check the price daily, right? I mean, real estate prices don't move. It's not traded in the market. It's not auction driven in the market. But whereas your stock portfolio, yes, your crypto holdings are. And so what happens, the minute they start investing in equities, they will start tracking their portfolio every day, and it becomes every minute, every hour. And it feels good to feel net worth is high, and it feels horrible to feel nothing wrong in tracking. But problem happens when human beings are not naturally wired to think long term. Because what happens is, when you track daily, it inculcates, without you knowingly, involuntarily, it invokes the short term mindset. And human beings are not naturally wired to think long term, as I said, because our brains have evolved from the caveman days of survival and short term thinking. So when caveman sees a tiger, the first reflex is to fight or flight, right? I mean, either run away or any danger for that matter. During cave days, their first response is either fight or flight. And that's a short term thinking. And long-term investing process is exactly opposite of caveman short-term mindset or instincts, right? So that is precisely why the game of investing is so complex, complicated, because it is against the natural human wiring, right? So there is a bias that is associated why we do this, right? It's called hyperbolic discounting bias. Little scary term, but what it means is, why do we value immediate rewards more than the long term rewards, even when the short term rewards are much smaller, right? The delayed gratification, nobody wants to go for it. The instant gratification that people choose, why is that? It's called hyperbolic discounting bias. The reason for our reluctance to think long term has to do with this bias. And think of an example, right? You getting $100 gift card now, would you choose that? Or would you choose rather a $500 gift card after 5 years? Most people would choose $100 gift card now, because there is a certainty of getting that right now, as against an uncertainty that you might get after 5 years, but you don't know what happens after 5 years. That the person who's giving it to you might exist or not, or they run away, whatever, right? So we give a lot of weightage to the short term certainty than long term uncertainty, and we confuse between uncertainty and risk. Most of the time the market is uncertain, it's not risky. That's a most important takeaway we need to have. Reason for short term thinking, control over long term thinking. Dopamine led reactions are short term oriented and addictive, whereas serotonin led happiness are long term oriented, contented, and non addictive. What are these things? Dopamine, serotonin are all chemicals in our brains, produced in our brains. There are many chemicals, thousands of chemicals. These are two popular ones. Dopamine is a short term one. That's why we keep checking our messages every 15 minutes, 30 minutes. We keep checking social media messages. Some new message excites us, dopamine. We keep checking stock prices, keeps going up, dopamine effect. We keep checking Twitter, Instagram, we're getting more likes, the dopamine hits. It's a constant process. Our minds are short-term oriented, and same as a trading mentality, right? And it's very addictive, if you notice. And that's pretty much like, most of the bad habits are addictive. They all give the dopamine. After we have that next thing what we want, we get the dopamine effect. So it's pretty addictive, but we have to control that. It's extremely, that's why most of the habits are addictive. It's, as Warren Buffett said, chains of habits are too late to realize until they become really late, right? It's too difficult to break until it become too late. So we don't realize that these habits tend to become more and more addictive, and we finally don't realize that we are unable to break that chain. So whereas serotonin is more of it creates a happiness over the long term. It's a long term oriented mindset, contented and non addictive. Taking exercise every day, having the diet control, having the discipline to read every day, having the discipline to save and invest every day, every week. These are all non addictive. These are tough things to do, but over the long term it creates happiness. Over the long term it creates contentment, but it requires a lot of discipline, right? So that's a difference. And it is exactly why we check our markets daily. We have the short term mindset and all of that. Single most destructive behavior in investing process, as I said, every one of us do this. Frequent hyperactivity in stock market. Even I keep checking markets. All of us go through that. It gives us a pleasure. Unabated deluge of information, analysis, reports, market data at our fingertips. Today, everything is at our fingertips. As I said earlier, market prices are continuously updated excuse me, in our mobile phone apps. And it's so easy to buy and sell stocks, right? It's on a click of a button, you could buy or sell stocks. But an activity I myself observed is, I rarely buy and sell. I do any activity in my Indian portfolio because one, it's 1% or something is a transaction fee. Second, it takes a lot of effort. You have to stay up in the night. I live in US, so I have to stay up in the night to do an activity in India, to do a transaction, maybe 11 o'clock, 10:30. So I don't do that, and it takes a lot of effort to place the order, track it, etc. So it involves a lot of effort. So I rarely do, and I notice that a tremendous difference between my performance between India and US portfolio. But in US, just a click, you are actively tracking it, right? I mean, so um, That makes a big difference. Now dopamine for the short term, like most social media apps give, when people frequently check the updates for likes and comments. Frequent activity triggers the unwarranted actions in our long term portfolio, disturbing the compounding process. As against what Charlie Munger said, do not interrupt the compounding machine, but we keep interrupting because we are triggered. These activities are triggering our these the data and information are all triggering actions which are unwarranted, unwanted. People keep switching in and out of stocks, reducing the weightages, increasing weightages to cover losses. Should I do this, should I do that? Mind is always preoccupied. Blaise Pascal's quote. I have told this in many of my YouTube videos, but all of the man's misfortunes comes from one thing, which is not knowing how to sit quietly in a room. This is so powerful, profound statement by Blaise Pascal, because even wars happen because of the same reason. The world wars happens because of inability of man to sit in a room quietly and do nothing. It's close to impossible, right? So this is why, if you see the average holding period of stocks in your US stock market, I put the chart, but globally, this is the scenario. It used to be 100 months in 1960s. 100 months is like, 8 years, 9 years of roughly. It has fallen from that period to 4 months in 2020 as recent. Now it could be even shorter. So the average holding period has gone down 95%. Thanks to the technology, thanks to the apps that we have at the fingertips, thanks to the activity, hyperactivity, we are able to bring down the holding period to nothing. And how in the world can we get a 100 bagger if we hold the stocks on an average for 6 months or 8 months? It's close to impossible, or even 12 months. I'm trying to improve, but the holding period has not gone up much. I'm trying to improve to 24, 36 months. As I said, India, I'm being able to do it. So make it discomfortable for you to activate or to do any activity in the market, right? That's one of the way to overcome that bias. And Thomas Phelps wrote a book in 1972 called 100 to 1, as I referred. He said, to make money in the stocks, you must have vision to see, courage to buy, and patience to hold. Patience is the rarest of the three, the first and the most critical step of long-term investing. Unfortunately, most people don't have patience in today's digital world. How to overcome this bias and correct the investing mistakes? Understand that businesses is not built in a day. It takes time. So investors need to set their return expectations accordingly. This means having a lot of patience and sticking with investments with an entrepreneurial mindset. Think like a business owner, right? Paul Samuelson had a quote that really explains the importance of patience in investing. He said, investing should be like watching the paint dry or watching the grass grow. I had done a separate video on this in my YouTube channel, but just wanted to bring this because this is correlated to what I'm explaining, the hyperbolic bias, right? So discounting bias. So the short-term mindset should be taken off. It's just like if you don't enjoy watching paint dry or grass grow, long-term investing is not for you. And it is a difficult process, but it's worth it, right? So Rome was not built in a day. Same as businesses, it takes ages. So we need to think like business owners. How to overcome one of the thing I might do a video on this as well. It's called Keystone Habit Model in Investing, influenced by the Power of Habit book written by Charles Duhigg. Now the Keystone Habit model is a very famous model in the famous book Power of Habits. It's a must read book. It's like Keystone Habits are nothing but, in the book he explains small changes or habits that people introduce into their routines that unintentionally carry over into other aspects of their lives, having a domino effect. Create a routine of checking the stocks you hold only once a quarter. Apologies for the spelling mistake. And that too just to understand how the business is performing, but not how the stock price is performing. As Peter Lynch says, most people, when Peter Lynch asked investors, why do you buy the stock? They said the prices will go up. That's the most common answer that comes up. But instead, the analysis should be like, why the business will perform better in the future. That should be the answer. So a stock price movement over 2 to 3 quarters is irrelevant. I had written that to my academy members when in the Upstart explanation, like if the stock had got corrected just because of the forecast not meeting expectations or the real results not meeting analyst expectation, I don't care a damn. I will add up more when the stock prices falls. The analyst expectation is the biggest advantage that retail investors have. They said the expectation, the earning doesn't match, stock gets corrected 15-20%. That's the opportunity. That's the algorithms executing those trades, those are the opportunities we need to take advantage of, right? I really like those analysts. They should keep setting those expectations, earnings expectation, and earnings should not meet match for great businesses. And I love that. I'll keep adding this to the stock, right? Now, apart from apps from phone and checking portfolio on the laptop, make it, don't look at the app, remove the app. This is a shortcut I'm unable to do. I'm still trying. Only look at your portfolio through your laptop. That could help, avoid those frequent checking and hyperactivity. So think like this: how to think like a business owner. If you own a local store or an online shop, like a car dealership, coffee shop, do you sell that hearing? Do you sell that shop or your dealership hearing that the Fed is pushing rates up, or do you sell your ownership partially because you expect a recession in the near term? Will you go and sell half of your cars in your dealership because you're expecting a recession, or do you sell your coffee shop because Fed is raising interest rate? No, because the sense of control is there when you are the entrepreneur, when you own the shop, but the sense of control is not there when you own stocks. But you need to develop that sense of control through conviction and stock analysis. That's a difference. Brings me to the end of module 2, and now next we will see module where we talk about the next 5 biases, very interesting ones. Stay tuned. Those are biases from 6 to 10, right? And let's get into. So the next 5 biases is module 3. Number 6 is buying or hesitating to buy due to recent performance of markets or stocks. So this is primarily driven by a behavioral bias called recency bias. And it's a very common bias that happens in our day-to-day lives as well. I had covered this in detail in my quarterly webinar in May 2022. And, this bias drives pretty much every aspect, is driven in, almost every aspects of our day-to-day lives. Starting with, for example, the whole concept is that the decision making is influenced by recent events, or recent happenings around you. If it's in markets, the recent stock price movements or the recent news or the recent past events could influence your decisions in the investing world. So it's a very powerful bias, and short term, it's like the short term memory takes control over the long term memory. Human beings are generally short term oriented in mind and thought in every aspect, but the memory aspect, the short term memory takes control over the long term memory. And although we know that although we are aware of all the principles, all the right ways and methods, but our brains get hijacked into the short-term memory thought process. So that is why people tend to not buy when there is a panic. For example, the stock prices, you can see the graph, there is a cyclical curve, right? In the curve, you can see that when the prices goes up, people think prices can only go up further up because it has gone up recently, or in the recent 6 months, 1 year. And that's why the bullish bull markets keep going up and up. It climbs the wall of worry. And on the way down during panic or fear or capitulation, people think that the prices can only get worse because recent price movements have been on the way down. So for example, we are seeing many stocks in May 2022, those are going down pretty much, and we tend to not react immediately, but over a period of time or consistently, when it falls, then we think like the prices can only go down, and people sell in panic. So this is driving the many of the behavioral aspects in investing world. Now there are 2 mistakes that we typically do. I have done this. So before I proceed, there is thunderstorms outside, so bear with me for the sound around. But the couple of mistakes that are associated here are, there are stocks which I want to buy. Best examples are IPOs or any stocks that had come with a great results, and I wanted to buy them, but then I would see that the stock price has gone up already 20% in the recent last 1 month or 15 days or 2 months, and it stays there. We want to buy, but it stays there, and we would we think that we missed the opportunity, and we end up not buying that stock at all, in spite of the quality that is there or the growth that is there. So that is one aspect. But in the long run, when a stock returns 100 times, 50 times, this 10% will look like minuscule. It has no effect in the long term. Similarly, when the market, the stock price gets corrected a lot,
that's the best time to buy. Sometimes our minds gets over hijacked, and we think like, oh, this is not the right time. What if the price further falls down? I might end up at a loss, etc. So then we don't end up buying that stock when the price is correct as well. So it is like funny cash 22, right? Either way, you're not reacting. And the funny thing is, investors don't realize that we are influenced by this bias, even if we are aware that such a bias exists. That's a funny part. The many examples I covered in the quarterly webinar also, like election results. Most often you see that the election campaigns happen just around the corner, like around the time election happens, like 3 to 6 months before is when the campaigns go very heavy, and that really influences the decisions, the outcomes of the elections. Performance appraisers in corporate jobs, or the performances of sports people, people who performed well in the initial exhibition matches or trials or the practices, tend to get based on their recent performance, they tend to get upgrades in the positions and game orders and all that, and even endorsements for that matter, right? So the people who are on who are the most happening get the best endorsements and advertising and all that. So it's a very powerful bias in our day-to-day life also. Now, how to overcome, I mean, so these we discuss both of these type of decision paralysis that can be caused by recency bias. So I have covered them here in detail. Same thing, it's never too late to buy a winning stock. If you have found a great idea, a great winning stock, it's never too late to buy that stock. We could have bought an Amazon in 2006, 8, 10, 12, 2015, 2000, even 17, right? Even now, probably could be a great buy. Now, it's just not Amazon. There are so many stories like that. It could be Apple, it could be Netflix, it could be any of the names, not only the mega caps. I'm just giving the names that I think of, but we get opportunities very often, and it is never too late to buy winning stock. They are winning stocks for a reason, and they are trading at a premium for a reason. So we need to give that valuation to the quality, not that overpay for it, but at a decent price. Whenever we get a chance, we should enter it, not wait for that, let it correct another 10%, another 5%. It doesn't make a big difference for a winning stock, because they're going to multiply 100 times, 50 times. It doesn't make any difference. The 10% will make a 0.51% difference in the overall returns in the over long term, right? So how to overcome this bias? We need to understand from past winners that it's never too late to buy a winning stock. With experience, we can overcome this bias. Let us take 4 winning stock examples. I have covered them here. So these are real life examples, as I said. Different countries. I always pick up different countries, different sectors, just to to remove any sort of sectoral biases for that matter. So HDFC Bank, the blue arrows in the chart indicates that you could have bought at any point of time during that journey, right? You could have bought at 2007, 10, 12, 13, 15, randomly anytime. It was all going up. And it could be a big buy now. In fact, HDFC Banks has corrected a lot. Apple, for example, you see that, 2017 was a good buy. When Warren Buffett bought, honestly, I didn't have the courage. I couldn't muster the courage to buy that stock, because I was thinking this is the largest company in US, or probably top 3. Pretty much, $500 billion. How big can it go? And it was around $200 billion, if I'm not wrong, in 2016 times. And then it went up 4-5 times from then, or 6 times or something. So, that was a 5-6 bagger for Berkshire Hathaway and Warren Buffett. So that's what it means. We cannot really say how much is a total addressable market, right? So it's a bias we all go through. I'm not over this bias. I'm hesitant to buy Apple. I'm not sure if it can go from 2 to 2 trillion, 3 trillion to 10 trillion. I don't know. I mean, I'm not able to get that conviction. Shopify is another example. Look at the chart. You have had a time in March before the Corona time, 2020. We thought that this is a peak in 2021, 22, before it crashed recently by 70%. Probably, it might take over the 2021 value, where is 21 peak, I would say, in the next couple of years. So that might not look the peak. It can go up. It was around $180 billion at all-time peak, and now it's around $40 billion, if I'm not wrong, somewhere around that. So if it has to go up another 4.5 times, potentially it can overtake that peak next 5-6 years, who knows? But So this blue arrow at the peak might look, good opportunity, but even today it is a great opportunity for, of course, after so much of correction. Mercado Libre. So this is a Latin American e-commerce company. So this is applicable across banks, financials, e-commerce, consumer products, every stock you take, any technology. The winning stocks continue to win. That's the story. Now, chasing near-term stock winners and funds. This is another typical bias we need to avoid, recency bias. Yes, I've seen this especially happening to a lot of people who choose hedge fund managers and who choose mutual funds to invest in, even stocks for that matter. People look at the near-term performance of fund managers and stocks that has returned, that has done really well, or the cryptocurrencies that has done really well. I know many people who invested in Dogecoin when it was going up, in the frenziness of all the stable coins. And I know people who invest in mutual funds by just looking at the last 5-year average performance and the or 3-year performance, and that does not mean that they are going to perform the best in the next 3 years or next 5 years. In fact, it's the other way around. There are many studies done like this. Fund managers who typically perform in the last 3 years, if you see the next 3 years record, they will be in the bottom percentile. So this is why another reason why fund manager is not able to beat the market. Beating the market is extremely difficult, and very few rare fund managers are out there, mutual funds, hedge fund managers who are value oriented, who keep beating the markets. They are different. So but don't when you have to assess the performance, go in like stipulated periods, like last 3 years, last 5 years, last 10 years, and take intervals of 3 years in those last 10-15 years to see if they are consistent. I mean, that would help to it should be running average. I mean, it should be a consistent behavior, consistent performance. Now, these are all speculative behavior. People, the things that keep going up. We have seen this in the 2021 bull market, like when the SPACs were going up, people were jumping into that frenzy. I know there are companies like C3.ai, which has corrected 98%. But then there are companies which are, I'm just calling out some of them, SPACs that IPO, A, B, C, D, whatever, that got corrected 90-95%. People were jumping into the bandwagon because the prices were going up. They wanted to catch the trend. And so the difference between the first mistake, that is, it is never too late to buy a stock. You might be confused. And second one, when it is going up, why not to buy? The only difference is fundamentals. So if the companies really have the good fundamentals, and the valuation should not be that, it's never too late to buy winning stocks, but doesn't mean that you buy it frenzy valuation. Shopify is a best example. If you had bought it in 2021 peak at $180 billion, you have to go through that time correction over the next 4 years, right? So it's not that you have to buy at any price. A good entry point would be based on the price to sales, or price to earnings, or price to gross profits, whatever you want to take, or EV to EBITDA, or cash flow, discounted cash flow. Best thing I follow is discounted cash flow. So you could go through my discounted cash flow methods and the valuation techniques. Even in spite of following that, there is a lot of assumptions inside discounted cash flow. So one can never get into the right frame of valuations, but at least we should not overpay for it. If we do that, we'll get punished. So that is a basic thing. Now, there are two biases causing these mistakes. As I said, recency bias is one we covered already. Availability heuristics is another bias that is very common. Availability bias also influence our day-to-day lives as well. What is that? Look at that picture. You have an all information set. That is, all the information is available in that superset, right? The circle, blue circle. But human brains, what we typically do is we pick information and heuristics. Heuristics are nothing but shortcuts. Heuristics means shortcuts to do things in our life, right? All sort of short, like driving, we use shortcuts. We don't apply system to brain, that is like a deep thinking brain every time we drive. It's many things are automated. When we shave, when we take bath, many of the activities in our daily life, we don't even are not even present at that moment when we do things. So it just comes, those are driven by heuristics. Now, information and heuristics we use to arrive at the decision, right? So any information that we look for and any heuristics we use to arrive at a decision are driven by some of the factors, like the recency bias, as I covered, the recent events, the recent news, the recent prices, etc. Frequency, how frequently you're seeing something, right? That can influence your decision. those are all available, right? And because news that are frequently available, for example, if you're watching, if you're reading or following Facebook, or if you're watching movies in Netflix, if you're watching YouTube videos, all of the places are using artificial intelligence, AI related algorithms to drive your interest, drive you towards your interest, right? Or to drive all of us towards our chosen interest. Suppose we search for, say, Nike shoes. The next time we log into Google or Facebook, or our mind gets channelized, it's called targeted campaigning by the media, social media, and advertising space. So the targeted campaign, what it does is it takes our attention towards specifically that particular product, right? So what happens is our mind gets cobbled. I mean, we tend to get frequent updates about the same thing, so our mind gets influenced. Now, recent events that we saw can influence the decision. Easily available information that is easily available, that's just one of the common mistakes. What people do is, for example, they go to Seeking Alpha, and if you tell a stock, they look at the 4 or 5 parameters: PE ratio, PS, EV, EBITDA, whatever ratios we use, and market cap, debt. That's it. That's the analysis most people do. 99% of people I know who invest in stocks do is pretty much that, or Yahoo Finance, or some tip ranks and all that. But nobody takes. I rarely see people taking the balance sheet. First going through the balance sheet, arriving at a valuation, and then comparing it with the market capitalization, which is what Warren Buffett follows. They don't look at the market cap directly. They don't look at the price to sales ratio. So they do that process because they don't want to get influenced by or biased by availability heuristics and recency bias. So once you see the market cap, that registers in your mind, and rest of the factors like return on equity and all that will register in the mind, then our decision will be influenced. Now, it's very difficult to do that. I'm not preaching here. I'm not saying that I follow that. I also tend to many times use shortcuts and heuristics. But the idea is to arrive at a place where you could take a business and without any biases, without reading any news, just analyze the business completely in and out, arrive at the valuation, and then go and reverse engineer, look at the price to earnings and all ratios, and historical trading average and all of that before taking a buying decision. So what is availability heuristics again? The whole information set is available, but we tend to take only certain amount of information from that set and then arrive at a decision, right? What is easily available for us, right? So that is the idea. Now, example, balance sheet and annual reports are available, but it's not easily available. It is not served to us in terms of like how Seeking Alpha, Guru Focus serves to us, right? Or how we track Coattail, other big investors' investments. These are all shortcuts, right? But nothing wrong in using shortcuts. It's a very advantageous thing to do. But at the same time, we need to do the due diligence before that. Another common mistake investors make is to look at recent performance. I already covered this. This is in hindsight, or rear view mirror investing, it's called, because we look at the past performance of the stocks, we look at the past performance of fund managers, we look at the past performance of the ETFs, and then we decide to that this could repeat the past performance. And precisely why you have that mutual fund message, especially in India, I think, and there is a caveat given: past performance is not a reflection of the future, past is not the prelude to the future, whatever. So that message is so true, because it need not be the case in the future. But having said that, there are certain businesses which keeps winning. So we need to do the diligence. How to overcome the bias? As I said, do the diligence, do the fundamental analysis, see if the stock price movement is rational. Not like, just because a SPAC is backed by some billionaire who happened to had no clue about investing, we have to jump into the bandwagon and lose money. We have seen many such ETFs and many such stocks that comes in, and we have to look at the businesses that is solid and backed by fundamentals. Having a checklist and following that will help avoid heuristics and heuristics-led biases. So the best way to beat any behavioral bias, for that matter, is to have checklist. And second is to have a process in place, have a method in place. As I said, first step, to take the balance sheet and annual reports and do the analysis without even looking at the price earnings ratios, any of the ratios, any of the shortcuts, then arrive at the evaluation and then compare it. And that is a good reflection process. So once we have a process in place, and why it appears in your watch list, why you have to invest after going through a checklist. The process will help evade out all the negativities and the biases. 7, the mistake is analysis paralysis, too quantitative. It's not very common, but I wanted to cover this because many investors and analysts get bogged down with too much data. Sorry for the typo. Data and information and analysis, thereby taking months to arrive at investment decisions. By then, the stock would have tripled or quadrupled, right? So it's not a good idea to get too bogged down by the data and to the decimal, value and information, right? Not having a framework based approach to arriving at investment decisions, that also could lead to analysis paralysis. If you have a framework, as I said, you can arrive at a decision very quickly. Giving too much emphasis on the quantitative aspects when analyzing a company that arrive at estimated earnings or to even 2-digit decimal points. This is a most funniest and entertaining thing I have seen in Wall Street, Indian markets, Dalal Street or Chinese market, wherever globally, this is the common phenomenon. Like there will be analysts sitting out there and giving estimates of the earnings and revenue estimates to the decimals, right? And if the earnings reports comes and then the company doesn't meet earnings to that decimal or even a minuscule percentage it is lesser than that, that's it. The stock gets butchered. It's down 15-20%. If it's a bad market, it's down 40%. We have seen enough examples. I've shown you Netflix example previously. So it's a very common phenomenon. And I have no clue why do they do that and what entertainment it gives, but it keeps everyone glued to the TVs and laptops. It keeps everyone glued to the market actions, right? It's like watching live sports. It's fun. Probably that's why. Now, they ignore the qualitative and business aspects like growth, optionality, etc. The most commonly ignored thing is optionality. I covered this in my quarterly webinar also. Like Netflix, for example, it got battered down. When the stock price fell, did not meet the estimation. The subscriber count was, I think, 200 million subscribers lesser, something like that. I know some count was a little lesser, 20% down or something. And because the comparison was against a very high base during the lockdown, pretty much everyone at home, the subscriber count, all the digital themes were having extremely great sales during that point. Many of us were subscribing to multiple service channels, like, Disney launched perfectly somehow, serendipitous. But, many media, many advertising, many firms, many social media, many digital firms were growing leaps and bounds during that year. So the base is very high in 2021. Now you're comparing as that 2022 results came, stock went down 40% straight, and the estimate was different. And similar is the case. Many stocks like that, not on Netflix. If it doesn't meet the revenue estimates or earnings estimate, margins, whatever, that's it. The stock gets battered. But those are great buying opportunity for value investors. Now, discounting future cash flows to the accurate decimal number is just a futile exercise. This is another thing I've seen, especially people who are from finance background. This is a very common behavior. They tend to, literally tear down the balance sheet in such a way that, to the decimal, they estimate the cash flows. And if the price to earnings is 15 and they arrive at a valuation, say price to earnings of 12, they will not buy the stock, however great the company is. I mean, that is true. And I've seen people looking at the electricity consumption in the balance sheet. And I've seen people looking at management, salaries and many, many, many things, so deep dive, such a level of, postmortem is not really required when you do the analysis. It's a good idea to have visibility to the future in terms of where the company is headed, growth aspects and all of that. Create a checklist. You don't have to track the electricity consumption or whether the CEO travels by flight, or all those are just a futile exercise or futile effort. And and another thing is, even the CEOs of the companies will not be able to prophesize what could happen in the next 5 years. I mean, as I said, Jeff Bezos himself wouldn't have known AWS would come into or cloud would come into existence through him in 2007, or through his company in 2005, probably, right? The iPhone wouldn't have been even in the visibility for any, if in the vision for Steve Jobs in 2000s or 2000 till 2009, 8, whatever time frame, right? So it is like optionality should be given a choice. I mean, we should always leave that chance and choice along with optionality, because such powerful platform with a lot of customers base, like Facebook, for example, that got recently battered. the optionality is huge. They could come up with anything in the future that we cannot even think about. Even the CEO can't think about. They are in the work. They are work in progress. So give that span of time. So do not try to estimate to the cash flow to the decimal and all of that. So I hope you got the message. This is the same thing I was talking about. Jeff Bezos wouldn't have realized, when AWS launched with the $0 in 2005, 6, I think. Yeah. So 16 years back, cloud even didn't exist. So, but then it started with, $0 at some stage 15 years back. And then now it's $40 billion. Who could have thought about that, right? So, it's a futile exercise to estimate and prophesize and all that 10-year cash flow, 20-year cash flow. I don't know what all. So next is effort justification bias. So this is another bias. What another mistake I've observed people doing is, I have done this enough times. We do thorough analysis and then we end up investing in the company because we put in so much of effort. We get influenced by that effort, or we think that the effort should not go in vain. Right? Suppose if I spend 3 weeks, 4 weeks to analyze a business, go in depth so much that we tend to think, oh, all the effort will go in vain if I don't invest. Let me put some amount of money, right? So that is effort justification bias. It's a person's tendency to attribute a value to an outcome which they had to put effort into achieving greater than the objective value of the outcome. No, it's not being objective. It's not being realistic about the outcome. But since we put the effort, we map the effort to the outcome. So that is the effort justification bias, and we should not invest based on that. How to overcome all these biases and correct the mistakes? Lots of things can happen in future for a business, like their products getting disrupted, new products or services that can get invented, acquisitions that can be made which are path breaking. AMD, we know, the Nvidia, for example. There are many companies who are not doing very well, and then they acquired a company that went on to do super. And there are many examples like that. I can't think at my fingertip, but there are many examples in especially healthcare sector, pharmaceutical sector, where some of the path breaking companies are acquisition candidates in many firms, and some companies grow just on acquisitions, and we don't know which acquisition will really turn the corner. So give that optionality always a place, right? And we don't have to do a guesswork there. We can always look at, analyze and see, for example, when Eicher Motors, the Indian company, started manufacturing, Royal Enfield, or Tata Motors took over JLR. It was a turnaround story for them, right? Jaguar Land Rover. Look where Jaguar Land Rover acquisition has reached, especially in China. So we need to always give that space. We can always look at the numbers. The numbers speak for itself. The first set of numbers can talk, and then we can look at arriving at a decision. We don't have to do a guesswork because a company acquired something. We have to look at the numbers if they speak for itself. Eighth mistake, emotional attachment to stock and companies. It's called confirmation bias. One of the most common bias out there is confirmation bias. Investors often get emotionally attached to stock markets and individual stocks. Usually happens when investors lost a lot of money. They tend to term market as unlucky, gambling, operated, etc. Instead of analyzing with a rational mind why it happened, why they lost the money. They fled the markets after a bull market turns, like a scenario now when the market falls 60-70% and stocks correct 90-95%. People just throw the towel and run. So in extreme bear conditions is when the flush out happens. All the people move out who are speculating, and they do not come back. That's an unfortunate thing. And but so people should really analyze rationally with a rational mind why they lost the money. And when they get big winners, they get emotionally attached. Especially this is very common trend. I've seen many big legendary investors getting emotionally attached to stocks and staying in for long periods of time. Sometimes it might work, sometimes it might not. So I know people who was a few great investors who had invested in Amazon, still holding the stocks, and it does work for them, and sometimes it might not. So we need to take a call based on how the growth is. A bias that causes investors emotionally attached to the stocks or entrepreneurs emotionally attached to the business is called confirmation bias. So when basically we have a stake in the game, we have a skin in the game, we have got emotionally attached, and so that can drive the future decisions that's relating to the confirmation bias. So what is that? In a pictorial format, I put in facts, evidences, data are available in one circle. There is other circle which is our beliefs, and we tend to we seek for data and evidence we believe in or we want to believe in. So that is a crossover, mutually inclusive set of both the circles right here. The arrow is pointing. We only take the evidences and data that we want to from the whole superset, just similar to availability heuristics, but this is based on the information. Now, investors often ignore the negatives of a company and focus only on the positive evidences to confirm their thought process. Because suppose this is a very typical thing, right? We are not able to do exercise, for example. Then we tend to look for expert advisors where the doctors say it's okay not to do exercises 5 days a week. It's enough if you do 1 or 2 days a week. We always looks for positive evidences to confirm to we have a bad habit, we don't want to stop. We look for positive confirm kind of evidences to confirm our thought process. We tend to ignore the negatives. This is happening in day-to-day affairs. Investors fall in love with the company, or people fall in love with the process, fall in love with the teams or the management. For example, we have some legendary investors, legendary entrepreneurs, right? Like Elon Musk and Jack Dorsey and many others, right? So we tend to get influenced. That's also called liking bias. We like them and we tend to follow them blindly. So we tend to ignore all the negatives and all the evidences against them. So political parties are similar examples. We have a bias towards, or we leaning towards a political party. We tend to ignore any negatives about that party. Most people don't even consider even how much of a brutal or the corruption is, or how much of a worse that political party performs. People who have a leaning towards them, they stick to that party because they avoid or ignore the negatives. They fight against you when you go and raise your voice. So people don't take rational decisions at all in life. And if you have a liking towards your players in any sports, if you have a liking towards your team, you tend to ignore and support your team. This is a social mentality, basically. So confirmation bias is also similar to that, but it has more to do with the data and information. So we tend to ignore the data. We want to believe in certain things, and we tend to accept the data only to cement those beliefs, to put it simple. So even in companies in business develop winner's curse. It's called winner's curse and confirmation biases. This is why many companies get thrown away from the businesses, right? It's again another confirmation bias. Why innovations does not come from and disruptions does not come from incumbent players in any field. I had given this example in one of my YouTube videos. Like, you take any disruption out there, like Kodak was disrupted in the completely out of, it was an incumbent in the photography world, and it was completely thrown out. Now Kodak doesn't even exist. It was a monopoly. It was called Kodak moment, right? Now Nvidia and Intel, look at Intel, where it was. Intel was the leader, and it was a monopoly, and it just got disrupted by Nvidia AMD. AWS, the cloud play. You take Tesla, electric vehicles. No, it didn't come from Ford, GM, or any of the existing incumbent players, because they are comfortable. They are going through the confirmation bias. They tend to ignore any innovation that is developing out there in parallel. People will laugh at, suppose the EV space, electric vehicle space is arriving slowly. When Tesla was building up in 2005, 6 to 10 time frame, people laughed at it. I mean, most people ignored it. People just wrote it out, saying like, this is not going to happen, and commercially it's not going to be successful. All sort of comments were there, but it came and disrupted the whole industry, right? Shopify is slowly disrupting many of the leading e-commerce players. Amazon was a disruptor itself. It didn't come from Walmart, right? It didn't come from Target. It didn't come from any of the biggies out there, right? But it just came from a new player. And most often, if you notice, all these are new players. It always is a new player who comes and innovates or disrupts. It's seldom that the existing incumbent player come and become big, right? So Square and PayPal that disrupted the banking. It was not JP Morgan who came up with the payments, the POS and the Cash App, right? So Snowflake is out there, MongoDB, we know, it's not Oracle. I can go on and on and on. So this is like a very typical, and this is because of the confirmation bias. They tend to ignore any disruption out there. They don't want to, innovate out there. They are comfortable in the zone, and they tend to continue that operations, and that's when they get disrupted. So that's again confirmation bias. The mistake number 9, trying to time the market. This is the most common mistake out there in the market. The number 1 mistake, if you say out of all 15, this will be the repeated mistake by everyone, including me. All of us keep doing this. In spite of knowing that we can't time the market, and we try to hold cash, we try to stay out. We tend to stay aside. We tend to buy more. We are always looking to time the market. The stock market, the term stock market itself brings us the flashing tickers, right? The green, red, and constant changing prices. This is what comes to people's mind, and people are trying to time the market all the time because people are influenced. All of us are influenced by the daily news, daily ticker, daily inflow of news unabated that comes into our phones, live streamed by TV channels around the world, showing live stock price movements as though it's a game, right? The live stock price movements comes. How does it matter, over a long-term 10-year period, whether the stock trades just $3 or $5? But people are, as I said, it could be an entertainment. I'm not sure. So when the stock and people discuss about the movement, and that's more funny. Many analysts comes and give the expert opinion why it went down $2 or why it went down 5% today. What do you expect to happen in the next 5 months? It could go up 10%. People speculate on the index performance, whether the index will touch 4,000 next 2 years. Will it go to 1,000? I mean, there is like unabated debates and happenings. It's pretty entertaining, honestly, and it creates a lot of media, news channels, and a lot of jobs and all that. That's fine, but we don't have to get hooked onto this. And pretty much why, if you see people, legendary investors wanted to avoid the noise. Warren Buffett stayed out of, stayed away from New York, worked out of Omaha, and John Templeton managed his funds from Bahamas. From a secluded, different country altogether. And then there is enough number of examples. People who, you don't need to be hooked into the Wall Street and the day-to-day media affairs and social media to be successful investor. That's a good news. And trying to time the market is a futile exercise. Nobody can time the market. We can do it to some extent in terms of direction and understanding cycles and all, but to the point, and whether it should fall 10% for me to buy, that kind of level of timing is difficult to do. And as I said, people are always trying to time the market by linking stock price movements to news, like daily news inflow in CNBC, many channels, Fox, whatever channel you want to call it, Money Control in India, Hong Kong channels and all that. So it's like near-term things drive prices. Near-term company updates like earnings. As I said, earnings does not meet revenue earnings does not meet analyst expectations. Stock plunges. This is what I was talking about. Look at Netflix. It lost 200,000. It is, yes, 200,000 subscribers, and that's it. It's compared against a high base. People often forget that. And look at the news that comes in. Right, I just pulled in a snapshot of that news. CNN. Netflix collapse is a warning sign for stocks. The way that is, this is a framing bias I spoke about in the first behavioral bias. Netflix stock plunges on the shocking subscriber loss. The usage of words are pretty interesting. Netflix crash and the company's shaky future in streaming. Netflix world has been turned upside down as stock plunges 35%. Now this is on Facebook. Is Meta the next tech stock to get routed like Netflix? Even Facebook went through that phase. Bill Ackman bet $1.1 billion in Netflix months ago, and now he's taking a beating. Netflix, and he ended up selling it also. The Netflix stock plummets 37%. As CEO company says company plans ad-supported model, which is good, in fact. Whatever the reason, this is just Netflix. You can search any news that comes out on earnings. This is the typical exhibition. So equity markets are the source of financing for companies around the world. Investors can channel their investments or wealth towards long productive assets of these companies who are looking to source the funds for their projects. It's just that. Companies are looking for funds. That's why they're in the market, capital markets. People are looking to invest in great companies and get benefit out of dividends and the cash flow and the growth. And that's why they are invested on the equities, right? So if we understand that, it's also a lot of problems due to these biases. The game of investing is a long-term game and requires long-term mindset. And this is my two tables I had created. Now, what really matters in the long term? Business prospects, revenue growth, profitability, earnings management. Over a 10-year period, 10-year plus, okay, and it could be even 5-year. I'm not saying it has to be 10. 5 to 10 year period onwards, up to 20, 25 years. What really matters is on the left side. But in the near term, short term, next 3 years, next even probably 5 years, but 3 years on an average, 1, 2, 3 years, what really matters is market related perception of the stock. So that is I'd covered this in my in the investing course, Game of Investing. The stock prices are driven by two factors. One is the company fundamentals, and that's the long term aspect on the left side. The second part is the price to earnings or price to sales, or that is nothing but it's a market perception ratio. The market's perception about that company, if it's bullish, the ratio will go up. That is PE ratio or price to sales ratio, whatever that market perception ratios goes up. Again, on the reverse side, if the market perception goes down, the ratio goes down. So near term, that drives the stock prices, right? Plus the earnings, obviously, it's a combination. But over long term, these noises out there, macroeconomy news, quarterly expectations to forecast to earnings, sales, price to earnings, price to sales, short-term predictions, price predictions, non-stop broadcast of news in media, etc., etc. All of those can influence the stock price movements in the market in the short term. That is driven by the market perception factor. So there are two factors, market perception factors, which is typically price to earnings times the earnings per share. EPS is the actual earnings that comes from the market, right? From the stock of the company. So you multiply this, you get the stock price, right? So stock price equal to price earnings times EPS, or EE cancels out, you get the price. So, but short term, this factor drives the market, has a major influence on the stock price. Even earnings has an influence. I'm not saying it has no influence, but it kinds of the factor has diminishing effect over the long term, over 10-year period, where the earnings will be reason for earnings. And I say, it includes everything, right? All aspects, profitability, revenues, all of that. The fundamentals basically will drive 95% of the stock price movements. So keep this in mind. Time in the market is greater than timing in the market. Timing the market, I've done a video on this. I just took the snapshot from there. This is like S&P performance, S&P 500 index performance. S&P 500, as I said, it's 500 biggest large companies over last 90 years. And the results are astonishing. 73% of the time in the last 90 years, the average return of S&P index were positive. 73/4 of the time, and only one fourth of the time is approximately negative. And on an average, it has returned 10%. Now, stock market indices returns over 5 years usually is positive. And for any portfolio, unless investors invest in peak of the bull market, like, NASDAQ peak or, 2008 peak, etc., 2007 peak, etc. So on an average, any index, if for a country like US or even Indian indexes like or Chinese index, they are all great performers. They're growth economies. Any growth economy you take, that country's index tends to perform pretty much reflecting the underlying economic growth and entrepreneurship, right? So if you take the 90-year history in US, you see that between 2/3 of the time, or 3/4 of the time, it is positive, and only 1/3 of the time it is negative. That is 25 years, and on an average, this is any rolling cycle you take, right? I mean, and you can see like how many. I put a breakdown there, like how many years it was up more than 5%. It was up almost 25 years. It was up more than 25% out of the 90, right? So and average positive return is 21%. Average negative return is 13%. So the differential value is what you get on an average over a long period of time. This is why I said 5 years is like a benchmark. If anything about 5 years, approximately, usually it's positive returns, and the average return is 9 to 10%. the last mistake here in the module, buying the rising tide and selling on the falling tide. So rising tide, when I mean, is the bull markets. When prices goes up, all the stocks goes up, all the junk stocks goes up, all the junk bonds goes up, everything goes up, right? That's a rising tide. It lifts everything. And falling tide is everything comes down, even quality companies comes down. But the beta might be different. Beta is the amount of market influence, but the sensitivity would be different. But at the same time, everything falls, all quality. But what comes back up is good companies. So bull markets, everyone's a genius, right? Everyone feels I'm a genius because this all the stocks that you pick, randomly it goes up. We had just gone through that in 2020, 2021 phase. As I said, everything was going up. Just pick and stay in the market, but it comes down at the same speed. What goes around comes around. So bear market has started now. Everything has fallen. What we have seen, 70, 80, 90%, and we feel we are an idiot. We've invested in many companies, thinking that will keep going up, and when we get the portfolio gets bashed, then that's when we think, gosh, we made such big mistakes, right? It's caused by two basic behavioral biases. It's called fear of missing out and fear of losing out. Why do we sell on panic, and why do we buy on going up market that is going up? We have to do exactly opposite. But human minds that has come from the survival instincts, the caveman days, we are always in the fight or flight mode, right? As I said, so human minds get swayed to over optimism and overconfidence during exuberant situation. These two are also biases, by the way: overconfidence bias and optimism bias. In exuberant situation, it's irrational exuberance, right? This is especially true in bull market, especially towards the peak of the bull market. People tend to overpay for the stocks due to the feeling, to the fear of missing out. Sorry, it's fear of missing out, FOMO trade. And the behavioral biases are associated are herd mentality, social proof bias. Human beings are always want to move in herd, and we need social proof. It's evident in our day-to-day life. We all look for social proofs all the time. We want to get that feedback. We want to get that like in Facebook. We want to get that tweet retweeted. We want to have so many followers. We want to have people appreciating all the time. We are social proof animals, and it's external scorecard that drives human beings mostly. And it is a opposite is what a typical investor needs to have, like inner scorecard, going against the herd, don't care about social proof, not having a hubris, that is overconfidence, and having rational mind. It's all opposite of human nature, and that's why investing is difficult. Optimism also brings in a feel of control for humans, although we know that it's not in our control. And all bull markets eventually leads to bubbles and a crash that follows. And the bubble burst at the peak and reversing the trend to extreme pessimism. This is on and on and on over the last century since the stock market exists. I've taken a slide from a snapshot from that was created by Dr. Jean-Paul Rodrigue, Department of Economics and Geography. I wanted to bring that point here. He has beautifully put. I was looking for a particular chart that shows the stages in a bubble. The initial stealth phase, then it goes to awareness phase, then it goes to mania phase, and then it's a blow off phase. We went through recently the whole cycle. It takes off, in extreme pessimism, like March 2020, Corona time, extreme pessimism, the world was ending. And then suddenly, institutional investors starts buying up. I mean, people start selling initially. That's a bear trap. Then people think the prices will further fall, but then it takes off. When it takes off, media attention catches. The reversion to the mean comes in. Enthusiasm builds in. Some new few trends comes in, like SPAC was the last one, or EV, e-commerce, digital themes, and new themes comes out of every bull market. Then there's a new paradigm. People call this is different. I think the most commonly used, and people say that's the most dangerously used thing. This time it's different. So this time it's different paradigm sets in. It's a new paradigm always, and it was tech boom. It was emerging markets boom. Then it was in 2008. Then it is the pandemic digital boom. Some boom keeps coming, some fads, and it was around crypto in between. And then it starts falling, it starts correcting, it becomes rational mind. People deny that, oh no, this is just a correction. Correction can happen only a few times. It could go down 20%. What max? I mean, I done a video on this YouTube. I'll probably share in the course description. People in the denial mode think that recession be max 30% correction. That's it. I can take that. When it goes up 4-5 times, I can take a 30% correction. But I done the video, explicitly called out, and it can go down 80-90 percentage, and that happens. And bull trap, it is called. It starts falling, then it gives you some hope. Then we think, okay, we can buy more, and then we get again trapped there, like opposite of bear trap. Then fear sets in, people run out of money, people throw money, institutions throw money, capitulation happens, they throw stocks, they sell everything, extreme despair, nobody wants investments, nobody wants stocks, everyone wants to be in cash. And then again, that's a time when extreme pessimism sets in, then again it takes off, the cycle continues, right? Between extreme optimism to extreme pessimism, between extreme fear to extreme greed. And if we understand this cycle, we can at least prepare, if not time the exact market. Social contagion and herd mentality, most common causes of almost all behavioral fallacies in the stock market. We are all human beings. We all have the social contagion, as I said, and social proof, herd mentality. We like to move in herds, whether it is different way we group ourselves with caste, religion, political biases. Even in any class you take, you have a group, right? I mean, that's how human beings move in circles, move in herds, and we get influenced by that herd mentality. We tend to follow and copy what other investors are doing. We follow leaders who are largely getting influenced by emotions and instincts, rather than by our own rational independent analysis. So herding is very common in every aspect of human life. It's a form of social proof bias that affect investors. Charlie Munger called this behavior as lemmings. Lemmings, follow, I put a picture there. Lemmings follow the crowd, right? And then just fall off the cliff. If you ask any lemming, it just says the front lemming is I'm just following. So human beings behave like that. Then they fall off the cliff, According to Britannica, someone who blindly follows a crowd, maybe even towards catastrophe, is called a lemming. That's the definition. There's the only reason why we have bubbles and crashes in the financial markets and the way markets are. How to overcome this mentality? Going against the crowd is like acting against the gravity for human beings. We going against a society is like acting against the gravity. So people tend to hang around in lines of society. It triggers fears in our minds. It could be a fear of losing, fear of missing out, fear of being wrong alone, fear of looking stupid, etc. That's why many people don't start investing. Many people don't start entrepreneurship. Many people don't leave their job and title. Many people are behind social status of exhibiting the wealth, all of that. So it's all social behavior. And how to overcome that? It's like Benjamin Graham said this, at least in the investing world, you are neither right nor wrong because a crowd disagrees with you. You're right because your data and reasoning are right. That's a perfect way to put it in life, right? And Warren Buffett said this: you pay a very high price in the stock market for a cheery consensus. In other words, if everyone agrees with your investment decision, then it's probably not a good one. Be greedy when others are fearful, and be fearful when others are greedy. Easily said than done. Then John Templeton said, like, there are two ways to beat the market: taking the non-consensus path and being right at that path, at that decision. So it should be ahead. Just because a crowd is it's crowding, it doesn't mean it's always wrong, right? So we need to be right at that decision when we go against the crowd usually. So brings us to the end of this module, and I'll now move on to the last module of this course for the last 5 investing mistakes. Thanks for staying till long, and hope the next 5 investing mistakes are even more interesting. So now we are entering into the module 4, finally, the last 5 biases and mistakes. And number 11 is not buying a stock since the price has gone up recently, and buying just because a stock has gone down from the first or the last price you're aware of. This is slightly different. It's a very interesting mistake and a bias that's associated with this. It's called anchor effect. It's a very common bias, heuristics that is affecting our decisions. Now let's take this example, right? There is a product that we want to buy, and suppose it is at a regular price is $1,500, but we see that the special price now is on discount. It's at $200. So what we do is, typically we get carried away. We're like, okay, now that's like a 70-80% sale, right? And the price that is first that we have seen, like $1,500, anchors in our mind, and then when it falls to $200, we tend to think that it's cheap, so cheap, it's fallen so much, and so we tend to buy. Same thing applies in stock markets. Now, when a stock that we are tracking closely, suppose if it's Tesla, Tesla was trading at say $1,200 in 6 months back, right? And currently it's trading at $700. And we tend to get carried away, like, okay, now it's on a sale, it's almost 30, 40, 30, 35% down. Let me buy the stock because it's cheap. Now, because a stock price that anchored in our mind, that is $1,200, we should not just buy because it has gone down 30, 35%. It could be a potentially a great buy time, but we need to do the analysis. So this is the anchoring effect that triggers in our mind. We should remove that anchoring effect by doing the due diligence, right? So that once that anchor reference point, sets in our mind, then subsequent action of the investors are determined or driven by the anchor effect. If this reference point wasn't there, then investors might take a completely different path, right? I've given a few examples here. Now, not buying a stock since the price has gone up recently. This is one of the common phenomenon. I covered this also as part of recency bias. This is also caused by anchoring effect. Now, for example, look at Apple in the chart there. It's around $119 right now. Now, this is a 5-year chart, right? So 2021, the price 2020, just before the pandemic breakdown, price was at, I think, $70, $65, $70 somewhere. And, that was the anchor price, and that got set in, right? Now, we did not, if you don't do an evaluation and think that the valuation is very high, then we might have ended at the further up price, right? Because we have seen that the stock price has gone up a lot recently, so that's recency bias, and the anchor price is set in our mind, and then we tend to think without analysis that this is the right price to buy in or sell. Now, investors will stay away from that stock, waiting for a correction to buy that stock, which would never happen. The stock can eventually double or triple from that point, and investor will end up waiting in endlessly. So this we saw already, this example, but it was for the reference of recency bias. It also is driven by anchor price because anchoring plays a big effect in our mind. Now, this is one example. The other example is buying a stock price that has gone a bit recently. Now, buying just because a stock has corrected 10 or 20% recently from a price level you are tracking, that is a reference point, or from a level of 52-week high, doesn't make that stock a compelling buy without analyzing properly. Now, many of us have this habit of looking at 52-week high and low. Just because a stock is trading at 52-week low, it doesn't mean that it is cheap. Obviously, it is cheaper than the 52-week high by half, usually 50%. Doesn't mean it is still cheap. We have to do the fundamental analysis to see why the stock is trading at whatever valuation, and then they take a decision. The stock could go and correct 90% from there, which has happened recently, right? At 52-week low, and it will keep hitting 52-week lows further up. People will buy the dip, and the dip gets further and further down. So without proper analysis, if you keep buying with a price anchor in mind with a 52-week high and low, then that is a recipe for disaster. Now, Tesla's example I gave in here, I just spoke about it. Our price anchor was say $1,200. Now it's at 732. People will think, oh, it's very cheap and buy. It could be, I don't know. But I'm just saying an example, right? But if we have to do proper analysis, and if it still ends up being cheap, then it's a good idea to buy. The next mistake is too diversified portfolio, risk aversion bias. Now, having extremely diversified portfolio is a common mistake I see, because I've not covered having too concentrated portfolio, because that is not a common mistake. It is a very rarity to see people being concentrated investors. So that's why I don't cover that. These are common 15 mistakes, right? So too diversified portfolio, it's 95% of people have too diversified portfolio, which I mean is ideally you need a portfolio of 15, 20, max 25 stocks, right? Most people invest in markets, create a portfolio of 40, 50, even 100 stocks. And even funny is they buy 15 different mutual funds along, or hedge funds and ETFs. This is due to a behavioral bias called risk aversion. Now, this is like, risk aversion is good in life, but, too much of that is also a problem. So this is because of too much of risk aversion. It's equivalent to buying the whole market itself, right? When you buy 100 stocks. Instead, better is to buy the index fund. Now, for average retail investors, it would make sense to have a portfolio of diversified enough to avoid risk of losing capital. As I said, it is coming up ahead in the next mistake. The risk of losing capital is to be avoided at any cost, but that happens only when you have an extremely conservative portfolio or when you're leveraged, etc. But many studies shows that there's no benefit of diversifying beyond 10 or 15 stocks in terms of risk management. Now, the other risk aversion is not buying enough of winners. Now, not buying enough of winners, and sometimes I see people investing like their net worth would be like say 200K or $500,000 or $1 million. They might have in stocks, maybe having some 10 stocks each. They would put say $500, and they will have say $5,000 in markets. And so that is not even 5%. It's a 0.5% of your total net worth, and 1% of total net worth. That is not going to make any difference in life. Another aspect is not buying enough of winners. People end up buying so many stocks that they have 3K, 5K, 10K. And then even if one stock, for example, in a portfolio of, say you have a 100K portfolio and you have say 25, 30 stocks, each 3K. And if one stock goes up 50 times or 100 times, let's say, so the 3K will become $30,000, $300,000, right? In spite of getting 100 bagger in a portfolio, your portfolio is still up only like say 3-4 times over long term, right? This is over long term. So that is not making any difference. When you get it right, we really want to make it big. So we need to develop conviction. And how do we develop conviction? We need to have the ability to go deep dive into these analysis. And as I given an example, when just allocating 2% of our portfolio to a stock that goes up 100 times, it can only increase a portfolio value by 2 times, right? I mean, 2% going to 100 is 200. So assuming all other stocks that you have performs like average 15-20%, you end up with a 2 to 3 times over a 15-year period, 10-year period. And that's not great enough, over a 10-year period. If you're multiplying by your portfolio by 3 times, that's very average, but instead index is better. So the idea is to get 10 times in 10 years, right? If you want that kind of a performance, you need to allocate at least 5% to 10% of your capital to a particular stock, especially if it's a strong conviction buy for you. You need to allocate heavy. This is what George Soros said. It's not whether you're right or wrong, but how much money you make when you're right and how much you lose when you're wrong. So the risk has to be balanced. I mean, low risk, high reward, that is asymmetric bets. Making large investments amounts when we get great ideas at bargains enables us to decrease risk and increase reward. So ideal way to do is, if you want to develop conviction, if you want to have strong conviction, to allocate heavily towards a stock business, and not one. I would say having a stock portfolio of 15 is great, and 15 divided, maybe 6% each is a good distribution. And that can make a significant difference in a portfolio if you get 100 bagger or 50 bagger. And how do we develop conviction? Because we want good valuation. When do we get good valuation? When others are panic selling. And when we get such valuation for great businesses, we need to load up. So that's how it works. 13th mistake is growth and value traps. Now, this is like not so prevalent, I would say, because people don't realize they are into that trap. What happens is like growth trap. Let me first cover that. Like, growth trap is fast and furious. Even businesses, it applies, right? To if you're starting an entrepreneurship, this applies to you a lot. You need to be cautious about this growth trap. Many companies grow at a rapid pace or try to grow revenues at rapid pace to attract investors, public or private equity investors, to become large in size, because when you tend to grow, the size becomes big. But many companies don't sustain that growth over long term, since there is no focus on profitability or quality of earnings. But what I mean by quality of earnings is good cash flows, right? And almost most of these firms will be cash flow negative, burning cash to grow the customers. And we have many examples like that that went belly up. Most often many investors fall prey for the rapid growth of sales and end up overpaying for these firms. They tend to match the sales growth and then end up overpaying, and there won't be any cash flows, there won't be any profitability for investors. And investors who really invest in such kind of growth at any cost, companies get stuck in the growth trap. They tend to reverse. So there are examples I can say, like Amazon, for example, is the best example. They were growing pretty fast. Most people compare any digital trend towards Amazon, saying Amazon has grown so much. Amazon had grown faster, but they didn't care about profitability. But now they are profitable. Now they have earnings and all that. But look, Amazon had a different story altogether. Not many people have analyzed that. Now, Amazon, if it had continued just the e-commerce loss-making business, we don't know whether it could have achieved whatever it has achieved today. I mean, Amazon had a strong pillar from 2005-6 onwards in the cloud business and tech business, and its prime was a brilliant idea. And they have got into media. They have advertising revenue coming from now, multiple other profitable businesses that are running, including cloud. Right, so it's a different story. E-commerce was just burning cash in the first few years, and many e-commerce players we have seen, unless otherwise they end up having some sort of profitable engine along. Like, for example, Mercado Libre has a profitable payments business underneath. Payments could be a good parallel track. Tech could be a good parallel track. Subscription based could be a good parallel track where there is a sustained earnings and sustained cash flow and profitability. That's very important. Return on equity and invested capital is pretty important, right? Just growing for the sake of growth, 100%, 150%. Many EV companies we have seen, they all burn cash and end up, fighting bankruptcy. So that's how it works. So we should not get into growth trap. Value trap is opposite. I mean, as the name says, this happens to traditional value investors. Most traditional value investors who followed Benjamin Graham kind of principles, they're too value oriented. They will not, as I said, they will not buy a company which is trading at 20 times earnings because they think 12 is right. That kind of entities exist in the market. So the valuations tend to orient around earnings, asset based, book value, and all of that. So one thing investors forget investing into these companies, that there is no growth in the future. They end up buying these low quality asset at cheaper prices, much cheaper or bargain prices, but there is no growth for these businesses, right? Or there is no cyclical. I mean, there is no secular growth. It could be a cyclical business. It could well be trading at a low price for a reason, but it what typically value investors are targeting is a 1 to 2 year holding period. Like the market perception gets so much beaten down about a stock that if the price to earnings, for example, goes down to a single digit number, like 2-3 times earnings, and they might be having earnings, but there is no growth potential. There could be so value investors try to bet on such themes. Sometimes they end up buying 10 price to earnings book, or 10 times or 12 times price to earnings, thinking that is cheap, but there is no growth, and they get trapped there. There are enough examples, like big retail, big conglomerates, retail conglomerates. There is no growth in those. A toothpaste, for example, what kind of growth companies they have? It's all saturated businesses, but they have high return ratios. They are big brands, right? And if they are trading at cheap, some investors end up buying those because it's cheap. And they could be cheap for a reason, and they can end up in a value trap. So usually when there is no growth, we need to be careful about that part. What causes this overconfidence bias cause value traps? Most value investors are well experienced, well learned, they have a lot of wisdom. Sometimes they get into such kind of, and there is nothing wrong. Mistakes do happen to everyone. We all do miss such mistakes. Even I have gotten into both value trap and growth trap, but it's a good idea to know what these biases exist so that we can learn and try to avoid, so overconfidence bias, overestimating our ability to predict the future and probability of success of our investment thesis. Now, value trap also could cause, especially value investors, many value investors could also end up not buying growth companies because they're not able to appreciate the growth ahead. So many value investors I've typically seen are not successful growth related investors. I'm not a believer of growth versus value. I believe both are tied at the hip, as Warren Buffett, legendary investor, said that. But and growth is an inherent part of that value. But what typically value investors look for, as I covered in the NEO framework, is they don't look at the innovation ahead, they don't look at the addressable market ahead, they don't look at the runway ahead, growth ahead. All of that is ignored, and they just look at the valuation purely from the asset that is owned by the company or the earnings that is underlying for the company. But they don't look at the third pillar, which is why I created the NEO value framework, which covers a third pillar, which is a growth oriented. So the value could be the growth ahead. That is often ignored by the traditional value investors. They tend to buy cheap and sell after the price retraces back. So that's another bias that is there. I am surprised many big value investors out there do not end up missing out on great companies like Amazon. They could have bought, even Warren Buffett ended up missing out Google, Amazon, even though they had chances to buy such stocks, So growth is a difficult thing to estimate for value investors. That is why. So it is usually caused by survivorship bias, overconfidence bias, and their own past, that is, I don't know what bias exists for that, what we call that, but, their own experiences, historical experiences stops them from buying such kind of companies, right? They cannot think of buying a company that is trading at, say, 40 times earnings, but it's growing at 75%, but high return on equity and return on capital. So such companies, they might tend to never buy. They will never be able to buy because their mindset is like too value oriented. It's survivorship bias to some extent because they have survived being value investors and they have survived creating great returns out of those kind of value investment thesis. So they end up missing out on the other ones, right? So what is remembered is their own value investment thesis from the survivorship bias. And what is survivorship bias? It causes both growth traps and value traps. It is investors sometimes take cue only from successful businesses, their successful past, their investment ideas from the past that have worked out in the history, and try to replicate such success in future investments. They never will change or adapt, right? They stick to that. And this might or might not work in the future, especially with the changing digital world, digital businesses, the business cycle getting shortened, as I said. Traditional value investing might or might not work, in terms of just looking at asset base. The world is shifting towards asset light models. There are not industrial, we are moved out of industrial revolution and the world is shifting towards digital. So we need to adapt ourselves, our investment thesis accordingly and not have survivorship bias and stick to only what has worked in the past. It might not work in the future. So we need to understand that. So just because something has worked in the past does not mean it will work again. So that is something we need to keep in mind and overcome the survivorship bias. Now, using 14th is using shortcuts, tips in markets, not knowing what you hold. Again, heuristics, very common thing in the markets. Pretty much, you see that, especially when I have discussions around many investing forums, it's the common question that comes is what to buy? Tell me which stocks to buy now. That's always people are looking for ideas in TV, in newspaper, in social media, Twitter, YouTube. Now, there's nothing wrong. Even I also look for ideas. We all look for ideas. Even I know big investors also coattail other big investors for ideas. There's nothing wrong getting ideas. But once we get the ideas, we need to do the diligence in terms of seeing if why we are planning to buy that stock. We have to create a write-up. It always helps to create a write-up why we are buying, because when it helps really, when we are ready to sell that stock, in panic especially, we have to revisit that write-up what we wrote, why in the first place we bought that stock. And many times I had experience of not ending up selling after rereading why I bought that stock. That thesis was there. So it could help avoid that heuristics. Now, it's a cognitive psychology. Heuristics is a dangerous tool in investing. It's a great tool in life. Heuristics are nothing but mental shortcuts helping people to solve complex problems and take decisions quickly. We have shortcuts in every aspects of life, whether it's in learning, whether in learning subjects in math, science, physics, or English, learning languages, learning driving, learning any game, everything we learn shortcuts to achieve success. And it kind of creates a mental model in our mind, wiring in our mind. It creates a network which is able to pull that thing very quickly from the short-term memory, just like a computer memory, right? It stores in the short-term memory space and it brings out immediately when we have to use it, right? When we are driving, it pulls most of the instructions from the short-term memory. When we are cooking, it happens. When we are painting, many of the skills as we tend to do more and more repeat, it creates the short-term memory and mental shortcuts in that. It's called heuristics. It helps in solving many complex problems. It helps us to live easily in life. Without heuristics, imagine the life, right? But it's a dangerous tool in markets. Heuristics are actually helpful easy living for humans, but they also cause lots of investing errors to humans. Why we use heuristics? Reduce the mental effort to the take decision. If you have to take a decision at every point of driving or any thing we do in life, then we will not be able to complete any task. Heuristics helps us to accelerate in every day-to-day life, simplify complex problems, shortcuts to success, quick arrival at solutions for problems. We use heuristics for all of that. For fast decision making, often relies on our emotions from past experiences and intuitions. So most often our decisions are driven by the past experience and intuitions, right? So the more experience and our intuitive mind and the short-term memory registers, it's a registered memory. Investing is actually a positive sum game. Now, why I brought this using shortcut tips is like, many people want to get these tips and shortcuts, to get rich fast. And that's one of the reason why people look at, developing that kind of mindset. Now, one of the important thing to understand is there are two, three things that is causing all these things: shortcuts to success, shortcuts to richness. Now, that's why there is a famous, I think Bezos said this, right? That only such kind of things sells fast. Nobody has a long-term mind. There is no book that will sell saying reduce weight in 5 years or achieve financial freedom in 20 years. Nobody will buy those kind of things. If you put a reduce weight in 20 days, that sells faster, right? So that's a shortcut mindset that we have. And so trying to get rich quick is one of the biggest cause of failure in the markets. That's usually driven by envy and greed. When your friends, social circles, when others are making money, we are getting greedy. We become envy. We want to catch up. We want to invest in the same themes. So most people are not ready to play the long-term game. Everyone wants to get rich quick, including me. So, but there is no shortcut in investing and compounding. I understood this towards the second half of my investing career. So, realize that come to terms in terms of realistically how fast can you compound. And the best of the investors has come at 20, 21, 22%. So we know where we can. And if there are people who have got wiped out of the market, this is definitely due to the get rich quick things like leverage, derivatives. They can really wipe you out and you can lose your capital permanently. That's the only way to lose permanent capital. Unless otherwise you invest in just 3 stocks that all go and building up. If you create a portfolio of stocks, the chances of wiping out capital in stock market is close to zero. Most important aspect to win game of investing is my course name, as you know, is to finish the game. I had covered this already. It's a positive sum game. Investing is a positive sum game. So we don't have to, it's not a zero sum game that only few people win. No, everyone can win in the markets if you can finish the game, because your target is what, 20 years, 30 years of investing period. If we are able to achieve 18, 20, 22% compounding, that's sufficient. That's what Buffett also did. And if we finish the game without losing capital, we will be very rich and much beyond what we can even imagine. That's a power of compounding. And, it's a positive sum game. So anybody who finishes the game is a winner. So we have to look at the finishing the game. All we need to do is finish the game, for which preserving capital is a crucial element. The first rule of an investment is don't lose money. And the second rule is don't forget the first rule. This is said famously by Warren Buffett. So preserving capital is a key. Someone will always be getting richer faster than you. This is not a tragedy. We have to keep this in our mind. What Charlie Munger said, when we see, peers getting rich faster, somebody getting lucky with a Bitcoin, somebody getting lucky with a trade, somebody getting lucky with some investing, some real estate, whatever. Somebody will always keep getting richer faster and than you. That's fine, but this is positive sum game. We have to also get rich. We just got to get rich only once. That's what Buffett said. It could be at age of 40, it could be 30, it could be 50. It doesn't matter. End of the day, we have to get rich only once, and after that we have to preserve the capital. So we have to keep this in mind and remove the envy and greed part out of it. Investing on tips and expert advice, again, shortcuts. There is no alternative for research in investing. People analyze and research for months before buying a television or a laptop or a phone, but people invest in stocks just on tips from an analyst in a new channel within few minutes. Most people have told me that they put their money in penny stocks, listening to somebody in YouTube, and that channel never existed after 1 year. We don't know whether that exists or not. That's one reason I don't talk about stocks in public media, whether in Twitter or in YouTube especially. I don't recommend stocks or talk about stocks. It's very easy to give a list and get some followers out of it. And followers will come in YouTube and Twitter only for people who talk about stocks, mostly, and because that's where people see value. And but the problem is, many often they get stuck in those stocks, penny stocks, small cap stocks, or fundamentally bad stocks, and then they never come into markets again. So that's the experiences. So it's not a good idea to just look at shortcuts and tips, especially from people whom we don't know, unless the source is valid. So it's a good idea to do the analysis, do the diligence, learn the game of investing. Most important reason why one needs to do the research, diligence, and analysis is to understand the business of the company and develop conviction in the business. So when the market goes down 70, 80 percentage, for example, we are going through in our model portfolio for the academy, many stocks are down 60, 70%, but we are holding up, right? I mean, it is because and if the stock has really fundamentally gone wrong, the business, then I would make a sell call. But unless otherwise the business model is disrupted or anything has changed on that front, why do we even take any action? In today's social media world, there are thousands of stock experts giving free stock, as I said, advice on YouTube, Instagram, TikTok, Twitter. People look for all these tips and buy the stock at wrong points of time and get stuck with the stocks after losing 80%. That's what I said. People buy a television or a speaker or a phone after months and months of analysis and waiting, but they put hard-earned money into such stocks and stable coins and all these, without any thought, right? So that's something to be avoided. It's not a good idea to invest on tips. And finally, the last mistake is notional loss and opportunity to buy when the prices are attractive. Now, what is a notional loss? Most often, the losses that we go through in the markets are notional loss. They're not real. They are, unless otherwise we book losses, we sell the stock. It is not a realized loss, right? So notional losses are which are unrealized losses because it is out there optically, but we have not experienced, we have not registered the loss, we have not booked the loss, right? So it is a notional loss. And most people panic and sell shares during recession and extreme depression or despair market conditions, seeing the notional loss. This is done so that they don't suffer further loss of existing capital, right? So they don't want that suppose a stock corrects 50%, they don't want the remaining 50 also to wipe out, right? So they want to preserve that remaining 50%, and for which they tend to sell that whatever is there and take it out, right? So that behavior is loss aversion. We already covered loss aversion and prospect theory, so not repeating that. Now, finally, the prices become attractive only when others sell. This is something to keep in mind, basic of value investing. When others are selling, it's not a time to panic, really. One principle that I've used through my career is to invest at the point of maximum pessimism. And this is said by John Templeton. That is a time to be most optimistic. Buy when others are despondently selling, and sell when others are avidly buying requires the greatest of fortitude and pays the great ultimate reward. Said by John Templeton, the legendary investor. Even Warren Buffett said in the similar lines as I covered in the previous slide, like buy when others are fearful and sell when others are greedy, right? So that's put it in that way. So that will help us overcome that bias. Reference materials for behavioral finance. We are at the end of the course. I hope I covered most of it. If there are any leftover, I will bring it in the quarterly webinars or append to the course, but I think I've covered most of the behavioral biases. But if you're more interested in learning and mastering the behavioral finance, there are a few books I could recommend. Thinking Fast and Slow is the first comes to mind. Daniel Kahneman, the best book out there on psychology, cognitive biases and all that. Poor Charlie's Almanac is a very good book, especially the chapter on misjudgment and human misjudgment, it's called, which I covered in one of the slides. I've listed all of those for 25 dysfunctions that Charlie Munger brought in. Then Noise, a new book by Daniel Kahneman, is a New York Times bestseller. It's a flaw in human judgment. It's a good idea to read that book. I think Influence book, I have not covered it here. I think I covered it in Game of Investing course. Influence by Robert Cialdini is a great book. Then there is Value Investing and Behavioral Finance by Parag Parikh. He was a legendary Indian investor, and I think this is the only book probably that covers investing and behavioral finance mapped. So a lot of reference I did with these books. And then there is Fooled by Randomness, written by Nicholas Taleb. I'm not a big fan of Taleb's writing, but this book is pretty good. I think there are many papers published by Daniel Kahneman and Tversky. They are famous economists, and they are behavioral economists, and so you could read all of that.